gold is gold is the only way to protect yourself against the currency crisis of the major reserve currency, i.e. the dollar, because technically the dollar used to be as good as gold. So we have to do like a regression theorem analysis. So that's the only way to protect yourself. And it's not just the dollar, of course, that's going to go. It's all fiat currencies. So that's that. So I've got here another Dow gold ratio chart. It's a weekly one and it's more short term. So you can see what's really happening now. We had a rally in the Dow relative to gold since April, but now we've broken this rising wedge, which is very bearish.
Mario Innecco used strong words when he stated that what we're seeing is the disintegration of a whole monetary system, not only a market correction. He clarified that when you zoom out and see a century-long fiat experiment unraveling, short-term volatility in gold signifies nothing. The long-term charts hardly reflect the recent decline in gold that alarmed dealers. Mario sees such as evidence that the bull market is still strong and only getting begun. He emphasized that all of the world's currencies, not just the US dollar, are declining simultaneously. Smart money is once again running away toward real assets as the short-lived dominance of stocks over gold has already reversed and broken out of a bearish wedge pattern. He contended that silver is exhibiting all the telltale signs of an early-stage bull run, including strong swings, quick recoveries, and increasing momentum. These pullbacks and spikes are signs of strength, not warning signs. Silver is still significantly below historical peaks when compared to the price of gold, indicating that the real gain hasn't even started. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing. Share your thoughts on the market in the comments below.
Yeah, they become political. So that's the way I see it. And as for yesterday, yes, some of you might have thought you kind of jinxed gold. You said there wasn't going to be much of a correction on the way to 4,300. But don't forget, I showed you a weekly chart. And this chart that I've brought up again here is from this morning. I updated it. And as you can see, that correction yesterday doesn't even register on this chart. So what I'm trying to say, yes, short term, there will be ups and downs. But I've said this many times. Hold on to your gold and silver for dear life. I saw someone on X, I forget his name, and I'm sorry that I'm not giving him the credit. Well, I'm giving him the credit, but he's got like a Russian name. He's a Western analyst. And he said, well, people keep asking me what innings we're in the gold bull market. And he said, it doesn't really matter. He said, we are in a monetary crisis. And I agree with him. It's like, yeah, we're like in Zimbabwe, Venezuela, or Brazil when they had their currency crises. Would you want to hold on to those currencies? And it's the same thing with gold, because gold is the only way to protect yourself against the currency crisis of the major reserve currency, i.e. the dollar, because technically the dollar used to be as good as gold. So we have to do like a regression theorem analysis. So that's the only way to protect yourself. And it's not just the dollar, of course, that's going to go. It's all fiat currencies. So that's that. So I've got here another Dow gold ratio chart. It's a weekly one and it's more short term. So you can see what's really happening now. We had a rally in the Dow relative to gold since April, but now we've broken this rising wedge, which is very bearish for the Dow versus gold. And it looks like we're going to dip a lot lower in the short term. Of course, 1-to-1 or less than 1-to-1 is probably 2, 3, 4 years away, or who knows, it could be very quick. But we will know when it happens because it will be 1-to-1 or even less. That's the way I see it. So let's look at silver, because silver is doing well too. Yeah, the volatility is quite pronounced. in the precious metals. And usually volatility in precious metals goes up as the market goes up. It's the inverse of the stock market. But yeah, so this, let's go back to the silver chart. Yeah, so it's the percentage of silver, the price of silver as a percentage of the price of gold, right? And Michael Oliver looks at it like this, and I think it's a good way to look at it. And as you can see, we're still in breakout mode, and we're still far away from where we were back in 2011. I think the gold-silver ratio got down to like 31, and as you can see, the silver was just over 3% of the price, which makes sense. And then if we look at a more long-term chart of that, the silver price as a percentage of gold, if we go back to 1980, yes, that was around 6.5% of the price, which takes it to around that 15-to-1 level. So you do the maths. If we go to $10,000 gold, silver could be at 1,500, 15-to-1, or it could be a bit less, but it will be a lot higher than we're now, and it's going to outperform gold because it does so in major bull markets in precious metals. The one in the 70s. And the one from 2001 to 2011, it did so. So we're still early days here for silver, I would say.
Mario Innecco believes that the Dow to gold ratio, a century-old measure of monetary stability, is quietly warning that another major financial reset is on the horizon. He traces the last 100 years to show how this ratio has collapsed twice before, each time marking the violent end of an inflated credit cycle. Mario now claims that the third major reset is about to begin. Despite constant central bank involvement, the ratio has been gradually falling for over 20 years after reaching a peak of about 45-to-1 in 1999. Every stimulus measure, rate cut, and bailout has just slowed the decline rather than stopped it. Today, the ratio is moving down again, suggesting what he considers the final compression phase, anticipated to happen within the next 3 to 4 years. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
Of course, and I think the Dow Gold ratio chart is a really good way to look at it, especially the monthly one going back over 100 years, as you can see here now by this chart. So that's how many ounces of gold you need to buy one Dow Jones Industrial Average. And you can see that I've got reset 1. Well, that happened in I think it was 1932 or 33 or thereabouts. And the Dow Gold ratio dropped to around 2. So in 1929, it topped just around 20. That's when the price of gold was $20.67 per troy ounce. Of course, there wasn't a price of gold because gold was money at the time, and the Dow went up to I think almost 400. So it was like 20-to-1, and then we had the 29 crash and the final bottom in 32. So that's when things reset, and then Roosevelt came in, devalued the dollar, revalued gold in 33. So this is the reset period is a period of great monetary, financial, economic, and even social convulsion, and I think we're right in it right now. So let's move forward. After that first reset, what the reset does, it allows the credit system to restart again. Yes, the Great Depression led to loads of bankruptcies. People unfortunately going broke, and then things started picking up again. Of course, it wasn't a straight line, and by the year 1966, we had another post-war credit boom, and I think the Dow topped, the Dow gold ratio topped around 26, and I think the Dow topped probably around 1,000, I think. And then for 14 years until 1980, it pretty much went sideways, above and below that level. And the reason this ratio dropped from 26 to basically 1 in 1980 was that the Dow went sideways, or maybe even some stocks went up a bit. But gold went from $35 per troy ounce to $887.50, which was the high in January 1980. And that completed the reset. The debt to GDP at the time was 35%. Yes, there was a big recession, a double-dip recession in the early 80s. Reagan took over and things changed. And ever since then, we've had a massive boom, financialization boom. And technically, though, this credit boom that started in 1980 ended in 1999, 2000, late 1999, when the Dow gold ratio topped just around 45, as you can see here. And ever since then, it's been going down. Yes, there was a rally, a correction back up when they threw everything at it to save the system. And by that, I mean loads of QE, loads of borrowing, trillions and trillions upon trillions. You can see they did it again in 2020 when things are starting to crash. But now, as you can see, and this is a monthly chart, of course, we're keeling over. And I don't think we have much time. And by that, I mean about 4 years, I would say, because if you look at the 1980 reset, we saw the Dow gold ratio rebound from the mid-70s up until, let's say, well, I think it was around 74 to 76, sharp rebound. And then it dropped, and it took 4 years for that drop to occur. And I think we are keeling over. So it could be 3 to 4 years from now, and that would take us to the late part of this decade. Some people see gold continue to go higher up until 2032. Who knows? But I think reset number 3 might go past 1. And what will that mean? Well, that will mean, for example, if we go to 0.75, that you will need 0.75 or 3/4 of an ounce to buy 1 Dow. If it goes to half, that means you need half an ounce, and so on. At what level will we be in terms of the Dow and gold? Well, it's difficult to say, but I tend to think it's going to be a lot higher for gold.
According to Mario Innecco, examining the Dow to gold ratio, a graph that covers more than a century of economic history, is one of the most effective ways to determine where we are in the global financial system. The number of ounces of gold needed to purchase 1 unit of the Dow Jones Industrial Average is indicated by this ratio. Each collapse of this ratio signals the start of a new monetary period and the conclusion of a significant credit cycle. The first reset, he notes, took place during the Great Depression. The ratio peaked in 1929 at about 20 to 1, which means that purchasing the Dow required 20 ounces of gold. The market crash in 1929 followed, and by 1932, the ratio had dropped to about 2 to 1. President Roosevelt essentially restarted the financial system at this time by devaluing the currency and revaluing gold. Similar to what we're starting to see now, Mario characterizes this reset as a period of extreme financial, social, and economic upheaval. He claims that the second reset took place between 1966 and 1980. The ratio reached 26 to 1 following a protracted post-war boom, but it dropped to about 1 to 1 over the following 14 years as equities stagnated and gold skyrocketed from $35 to almost $900 an ounce. The system's excesses were eliminated by this reset, which also prepared the way for the financialization era, which started in the 80s and marked the next significant boom. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.